All right, let's get started. We're going to go through our chapter 5 lecture notes. And so I'm just going to work through these with you. It'll be a lot shorter than chapter 4. Chapter 5 is, and 6 and 7 and 8 and 9 are much smaller. And so chapter 4 is where we really get into doing all the journal entries for both sides. And the general fund covers most of the entries. And we'll be doing a lot of similar entries as we get through 5 and 6 and 7. So it won't be completely new concepts to us. The chapter starts off talking about general capital assets. So when we use the word general, we're talking about like the general fund, usually, or ones that are used by the governmental funds. And so when you're in the proprietary and the fiduciary funds, it's a little different because you actually have the ability to record long-term assets. But remember, in the governmental funds, everything is considered current because everything is intended to be used within the current period. So we don't depreciate in the general fund because in the general fund, it's not considered a long-term asset. So there's no reason to spread it out over multiple years. So in general, we know of long-term assets such as land and buildings and things like that. And so in ways that we finance those long-term assets, because this chapter is going to deal with our capital projects funds. Capital projects is a long-term project that's going to last potentially multiple years while we do it, or we're building some kind of long-term item like a building or whatever. And so this is the process we go through in the city of actually creating a road or whatever. So let's go through. There's a section here where it talks just a little bit about like the entries that you do. All right, so here, this is for the general fund. And so we really shouldn't be talking about it in chapter 5. It really should have been covered in chapter 4. But this chapter covers the concept of acquisitions of long-term assets. So if we buy equipment for the mayor's office and we pay $50,000 cash from the general fund, then what we're going to do is we're going to go ahead and normally, if we were using financial accounting purposes, we would just debit equipment and credit cash. And that is what we'll do at the government-wide level. So the government-wide level, it'll be just like it would be in financial accounting. You bought equipment and you paid cash. But up here in the general fund, there's no such thing as equipment because everything is considered a current item. And so we're just going to go ahead and debit expenditures instead. So we'll use expenditures rather than equipment because we spent money. And so you would have to encumber for it first and then expend. So again, depreciation doesn't happen at the fund level, but it does happen at the government-wide level. So you would go ahead at the government-wide level and depreciate that equipment over its useful life, just like you would in financial accounting. So capital leases, this is a concept that we talk about in intermediate accounting, chapter 15. So some of you've already had intermediate 2 and some of you haven't, and that's okay. But the idea of a capital lease versus an operating lease, I don't know if you guys remember it, and it's okay. You don't necessarily need to have had intermediate 2 to be going through this concept, so don't panic. So an operating lease is a regular lease. It's like if you rent an apartment for a year, and so you're using it for 1 year and then you give the property back. For a capital lease, there were 4 criteria, and if you met any one of the criteria, then it was considered a capital lease. And it was things like a bargain purchase option at the end of the lease term, or you got to keep the asset at the end, or you held on to the leased asset for more than, let's see, man, we're pushing there's like a 90% rule and another rule. Anyway, so I think it's over half, but I don't remember. So I guess now it's going to bother me. So now I'm going to go look. Let's go look. So I'm going to go to intermediate 2, which I teach every spring. And so I just remember that there's a 90% rule. Oh, it's a 75% rule. A 75% rule. So if you hold on to the asset for more than 75% of its useful life, then it's considered a capital lease. And then if your payments, if the present value of your minimum lease payments is more than 90% of the fair value of the asset at the time that you buy it, then it's considered a capital lease. Again, you don't need to know any of this, but now because I feel like I need to, I'm going to go pull up the chapter 15 lecture notes for leases, and then I'm looking for my 4 criteria. Here they are. Bargain purchase option, I mentioned that. If you get to keep the asset at the end of its useful life. So if you hold on, if the lease term is more than 75% or more of the useful life. So if it's a 5-year asset and you're leasing it for, like, if its useful life is 5 years and you're leasing it for 4 years, that's 80%, 4/5. And so then it would be considered a capital lease. And then if the present value of the minimum lease payments is 90% or more of the fair value of the asset. So if you take your lease payments and if you're leasing an asset for, 5 years, but it's a 30-year asset, then you don't have to worry, you did not meet this. But then if you calculate what your minimum lease payments are, like if your payments every year are 10,000, and then you calculate the present value of those $10,000 payments, and then if that exceeds 90%, so 90% or more of the fair value of the asset when you bought it, then it's considered a capital lease. The whole reason why this matters is a capital lease. When you have a capital lease, then you record it as an actual lease equipment and lease payable, and then you make payments on it. And so you actually bring in the asset you're renting as an actual asset, and then you get to depreciate it. And you make payments on it and you amortize it and all kinds of good stuff. And so we learned that in intermediate 2. But what we have to know is at the fund level, it's considered like everything is just an expenditure. So you don't have to worry about like capital leases. So that's really the only concept you need to worry about. So capital lease used by the special revenue fund with present value of minimum payments of 50. So basically the special revenue fund is leasing an item and it is considered a capital lease. So that means that it met one of the 4 criteria, any one of the 4 criteria. So if it's a capital lease, then what we're going to do at the fund level is it's just going to be an expenditure, but at the government-wide level, we'll do equipment and lease payable. Now your book probably uses a fancy word for it. So capital lease payable is fine. So you won't do any homework doing this. So, but I do want to introduce it to you because it's covered in this topic and it is always potentially on the CPA exam because everything is. At the fund level though, we're just going to call it an expenditure. And so our credit though, so what we're doing is we are acquiring this lease, but we're not going to make payments on it yet. The lease payables here, but for the purpose of the fund, it can't be a long-term item. And so the only thing I can really credit is an OFS. So basically it's the way we're financing this. So it's another financing source. We're financing it through a capital lease agreement. And so we're making the payment, and every time we make a payment, we're basically financing this lease. So really weird. All right. So as far as disclosures, there's all kinds of things you have to put in the disclosure notes about capital leases. And so, and then once you've actually acquired the asset, then you are going to, you're going to have to go ahead and capitalize any extra like repairs or things like that. And there'll be expenditures at the fund level. And so if they better the asset for like a long-term process, then you could potentially put that in as like a leasehold improvement and then write that off over years. So, all right, so now let's go ahead and dispose of some general capital assets. And so it says assume a machine is sold for 500. The asset had originally been purchased for 8,000 using general fund revenues. It was fully depreciated. So at the general fund level, remember when you bought the asset? When you bought the asset for 8,000, you just did expenditures and cash. So remember that from the mayor's office situation. So back when you bought it, you expended the whole thing, no problem. So now when you sell it, you're just going to bring in $500 and it's going to be revenue. So at the fund level, it's just going to be revenue, just like it was just an expenditure. But at the government-wide level, you have to go through and calculate get rid of the equipment, get rid of its accumulated, show the money coming in, and then you have a gain or loss on the sale of the asset. So the government-wide level, it's like financial accounting. When we sell fixed assets in financial accounting, we get rid of the equipment account and then also the accumulated depreciation account, however much it's been depreciated. And then we show any money coming in, and then the difference is either a debit or a credit. And so it's either a gain or a loss. So the book value of this equipment, it says it's fully depreciated. So the book value is 0 and we're selling it for 500. So that would be a $500 gain. So to do the journal entry on that, to do the journal entry on that, we're going to have the equipment leave the building. And that equipment had a cost of $8,000. It's accumulated also needs to leave the building. So that would be 8,000. Okay. From there, we will show the cash coming in. And the cash coming in was 500. So to make the debits and credits work, I need a gain. And so we can put gain on sale of equipment. And we'll put 500. Okay. So let's do another one where we have a building with a cost of 100 is demolished. It's fully depreciated. The cost to demolish the building is $5,000. So we did not sell it. It's just going away. So we have to pay $5,000 to knock down the building. So this would be an expenditure in cash. So at this point, remember when we bought the building, we just did expenditures in cash as a purchase. And now we're having to pay more to get rid of the building. So down here, then we need to get rid of the equipment or building in this case. So we need to get rid of the building. We need the buildings accumulated to go away. We are paying cash. So now I need a debit. This is what I would call my plug, and it would be either a debit or a credit to make it work. And so we'll call this loss on sale of building. But it really wasn't a sale, so I guess it was demolished. But regardless, it's a loss. So we can just put loss on building. So on our income statement or our statement of revenues, expenditures, and changes in fund balance, it would go in with the expenditures section, but probably in the lower part in the other, like where you put other financing sources and other financing uses, it would probably go down in there, not in the main stuff. But this is at the government-wide level, so it wouldn't go on the statement of revenues, expenditures, and changes in fund balance at all. This expenditure would go in the expenditure section, and at the government-wide level, this would go in with other gains and losses and stuff. So, all right, so as far as asset impairment, this is when an asset loses value that is significant, like an unexpected decline. This would be like wrecking your van that's not insured, that is not fully depreciated. And so, so physical damage, obsolescence, whatever. And so there are different methods for how you can do this, but basically we are just going to write it off as an expenditure at the fund level. And at the government-wide level, it would be, it would just be like an extraordinary item usually. So report as extraordinary or special, report impairment losses, like net of insurance recoveries. So, okay, finally what I was waiting for. I was talking fast because I was excited to get to our capital projects funds. So remember PIPA C-gripes? And so PIPA is the fiduciary funds. C-gripes, the vowels are chapter 7, I and E. But C-gripes, G is general, all right? C is capital projects, and that's what we're going to cover in this chapter. So we're going to focus on capital projects funds. So what we're going to be doing is we're going to be building big stuff, okay? So we're going to be building a new highway, or a building like a city hall, or a swimming pool, something that is significant, that's going to last many years. So all of those kinds of things will be considered capital projects funds. So these funds are sometimes financed through a bond issuance, and then we would have like a debt service fund situation where we would be paying off that debt. Sometimes they're financed by a grant of some kind. So we'll have like an OFS, another financing source coming in to pay for it. Sometimes it's just a transfer from the general fund. So the general fund has excess general revenues that they're going to give us to work on this. So however we fund it, we'll do that, and then we'll have expenditures to go ahead and pay for the project. So the first thing that normally happens in the system is we have to authorize the project. So we have to get approval from the city council or from the citizens if we have to ask them in a voting situation whether we can or cannot do this. So if it requires some kind of long-term financing, often you're going to have to go through this, like the voting process to make that happen. So assume approval is obtained for a federal grant of $100,000 as partial funding for a city office building project. So the first thing that's going to happen is we are going to get approved for a federal grant. Now we don't have this money yet. It's coming,
but we have approval has been obtained. So we are waiting to receive that money. So here we are going to due from general fund. So this is money that's due from the federal government, okay, because it's a federal grant. So that's why I'm going to use the federal government. So due from federal government. Now remember, this is an asset. It's like accounts receivable from the federal government. And this will be our revenues. Okay, so in this particular fund, this will be considered revenues. You can maybe even also do an OFS instead, just depending on like what kind of revenue it is. Like it's a grant, so sometimes we call those OFSs. But if this is part of like the process, like if the capital projects fund is funded by a grant, then we don't need to specify that that's an other financing source because it's the financing source. So we're also going to have more money we're going to spend though. But the first thing we're going to do, because we need to like figure out what we're building here, it's a building project, is we need to get an architecture involved, like an engineer and stuff like that, to design the building. So assume for the office building project, $50,000 was borrowed from the general fund to be repaid later from bond proceeds. So right now, the capital projects fund, this is the very first transaction that happened in our fund. Now we're going to have capital projects funds for all of our different projects. So if we have a project where we're building a swimming pool at the same time as the city building, those will be two separate funds and we'll be like operating each of them. Another way to do it is we could have one capital projects fund and we could say due for federal government, and after each one put like dash building or dash, you know, the city hall building or whatever, or dash pool, and like keep track of each one separately. I like to just put them in a different fund because then you can kind of keep track of them easier. But if we have one person managing the capital projects fund and they run everything out of that fund, that's fine too. So right now we have no money, but we need to go ahead and borrow some money because we need to go ahead and get some architectural designs locked down so that when we get the full financing, we can get right started building. So assume that to obtain interim financing to get the architect involved, we are going to borrow $50,000 from the general government. So I want to look at what that would look like at the capital project fund level. And I also want to know what will that look like at the general fund level. And so then also we'll talk about government-wide in a minute. So let's go through and look and see what this would look like. So the capital projects fund is the one borrowing money, right? So they are going to receive money. And the general fund is going to give up money. All right. And so as far as the credit, this is money we have to pay back. So it's some kind of payable, right? So we're going to call it interfund loans. Man, get spelled today. Payable dash current, because we're not borrowing it very long. And then at the fund level, they're the ones that are going to receive the money. So we'll call it an interfund loan receivable dash current. So this inter funds will always offset each other between two funds. And so in the capital projects fund, this is money I owe, and in the general fund, it's money I'm going to receive. So eventually we'll have to pay that back. But if you look at what happens, like the general umbrella, I'm always doing that. I don't know if you can see my little picture off to the side, where I'm talking about like the whole umbrella. And then like the general fund is under the umbrella, but so is the capital projects fund. And so is, you know, a debt service fund. And so is a special revenue fund. So underneath there, underneath the whole umbrella, those people just traded money. But at the government-wide level, nothing happened because we didn't bring in any money to the government and we didn't spend any money in the government. It was just people trading money inside. So this would be like in my house, if Lauren, 14, loaned $5 to Claire. She's 9. So if they loaned each other money and then they paid each other back, no extra money came into my household and no money left my household. They just traded money briefly. So, okay. So, all right, a contract was let. That's such a weird phrase, but that's how they phrase things. That's a normal way to phrase things with contracts. So a contract was let in the amount of $50,000 with an architectural firm to complete the architectural design for the new city building. So the capital projects fund then is going to go ahead and commit to spending $50,000. So we understand that at that point that it'll be an encumbrance and a reserve for encumbrance. So we are basically committing to spending $50,000. And then we don't actually spend any money yet because this is just us committing to spending the money. But then the architectural firm for which an encumbrance of 50 has been recorded above tendered its final billing in the amount of 48,000, and we're going to go ahead and pay it. So for the capital projects fund, we're going to go ahead and reverse the encumbrance, and then we're going to spend a little less. So when we reverse the encumbrance, debit reserve for encumbrances. Did I spell that wrong? Encumbrances. There needs to be an N. Sorry. And encumbrances. So reverse the encumbrance at what it was set for above. So it's this exact reversal of this one, and then expend only 48. Aw, that's nice. And it said we went ahead and paid it immediately. It could have been vouchers payable there, but it did say we paid it right now. So the government-wide level, they didn't do the budgetary entry because they don't. So they don't need to do the reversal of it, but they do go ahead and expend the 48,000. Now we know that when we expend, we normally just change it to expenses in the general fund. But what's happening though, is we're actually building a building. So we're actually constructing a building. And so we're going to use an account we learned in chapter 6 of Intermediate 1, construction WIP. So we spent $48,000. So at the government-wide level, we're actually constructing a building, which will eventually be depreciated. So we're going to use construction WIP, and that's where we're going to put all of our expenditures for this project. And then at the very end, then construction WIP will turn into a building, which will then be depreciated. So you guys have done this before, probably, but if not, it's okay. So while you're in the process of building it, you put it in a WIP account like we did in managerial accounting when we were making goods. So, but this is a construction WIP. So we are creating a building. So all the costs to create the building will all flow into that account. At the end, whatever the balance is in construction WIP will turn into a building, and then it will be depreciated over time. Now, remember at the fund level, it's just an expenditure because we only use current focus. And so with that modified accrual basis, and so we don't actually record equipment or construction WIP here. All right, assume the bonds with a face value of 5 million were issued at 101 to finance the project. All right, so this brings us back to financial accounting. In financial accounting in chapter 10, we uncovered that idea of 101. And so what 101 means is 101% of the face value. We also covered it in chapter 14 of Intermediate 2, where we did bond issuances and then we made payments on the bond and we discount the premium, or we discount the we amortize the bond discount, or we amortize the bond premium. So when we're looking at this, when we issue a bond at face value and we get more than, because in this case it's more, right? We get more than what we're expected to receive. So let's go ahead and show what that would look like at both the fund level and at government wide. And so at the fund level, first let's acknowledge that we're going to receive cash, and instead of receiving 5 million, we're going to get some extra because 101 means 101%. So 5 million times 1.01. So we're going to get 5,050,000. Okay. And so basically 5 million of it is what we get to keep. We don't get to keep that extra money. All right. We don't get to keep the extra. We only get to keep the 5 million. So we're going to do OFS, which is another financing source. And we'll call that proceeds of bonds. So the 5 million is ours. We're going to use it to finance our project. But the other money, the other 50,000, will be used to make interest payments on the bonds and stuff. It's going to be used by the other department. So we're going to do two, and you can just do other funds, or you can actually say the debt service fund. We're going to give that money to the debt service fund. So we've got it right now, but eventually we're going to turn it over to them. Now, sometimes when the money comes in, like they only give us the 5 million that we were asked for, and the other 50,000 just automatically goes to the debt service fund. So you'll see that in your homework. So it will tell you like whether we got the whole amount or whether we're only getting the face amount. Because the face value we get to keep, any extra will be turned over. So due to liability account, money owed to the debt service fund. But at the government-wide level, we're going to receive cash of $5,050,000. And we're going to do bonds payable of $5 million. So this is exactly like what we did in financial accounting. And so this is called premium on bonds payable. Okay, so that's just like what we did in financial accounting and intermediate accounting. All right. So as far as implementing the project, now we're going to go ahead and use that money and we're going to go through the construction phase. And so some of these are filled in for you because it's just a lot of entries. And so I went ahead and just did them for you. So for the capital projects fund, the first thing that happens is we're going to go ahead and get that grant that we were waiting on. So we're just receiving that money from the government. Same for the capital projects fund and the government-wide level. At that point, when we got that money, we go ahead and pay back the general fund. So we're paying back the payable. At the general fund, we're receiving that money, but nothing happens at the government-wide level. At that point, we're going to go ahead and sign a contract to go ahead and get Capital Construction Company to build our project. Now it's for $5,050,000, which is fine because remember we got a $100,000 grant. We spent 50 of it. Really, we only spent 48 of it on the architecture stuff. So we have 52,000 left over from that $100,000 grant, and we have 5 million. So we're fine. So 5,050,000. So a contract was signed. And so basically what happens there is we're going to go ahead and we're signing a contract to eventually spend money. So it'll be encumbrances and reserve for encumbrances. But at the government-wide level, no entry. And then it says a partial billing of 3 million was received. So we need to reverse the encumbrance for 3 million. So this is just a partial billing. So we'll get another billing later. So reverse the encumbrance, and then we'll plan to go ahead and spend the money. We have not actually paid it. So remember on the architecture firm, it's like pay immediately. So we're probably going to use like a vouchers payable or a contracts payable. And so in this chapter, a lot of times we'll call it contracts payable. So we're going to go ahead and expend some money. So construction expenditures for 3 million and contracts payable. Now the government-wide level, they do not need to do the encumbrance entry, but they do need to do this entry. But instead of construction expenditures, we're going to call it construction WIP. Now it's time to go ahead and pay that bill. But when we pay that bill, what we do is we withhold a little, because if something's wrong with the project, we want to be able to follow up and get them to go ahead and pay for whatever's wrong. So if we make their whole payment and we pay off the whole bill, then if something's wrong, then I don't have any like carrot to get them to pay for the rest. So I'm only going to pay 95% of it, and the other 5% I'm going to retain or keep. Remember, retained earnings. Retain it or keep it and hold off till the project is actually done, and then I'll give them the rest. So what I'm going to do is I'm going to eliminate contracts payable for 3, and then I'm going to withhold 150,000 and pay the 2,850,000. So of the 3 million, 5% of it I'm not going to pay. So I created a new liability account called contracts payable retained percentage, and that's the money I'm going to hold on to until the project is completely done to my specifications, like to what the contract said they do. Same exact entry at the government-wide level. Oh, why is that? Okay, so the Capital Construction Company completed the city office building and tendered its final bill for 2 million. So now we're going to receive one more bill for 2 million. So we're going to reverse our entire encumbrance. Now remember that we put 5,050,000 in encumbrances. So we reversed out 3. And so now we need to reverse out the rest, the 2,050,000, and we're going to plan to spend 2 million. And that would then change to construction WIP, which is all good. And then we're going to go ahead and pay it less than 5%. So of the $2 million bill, I'm going to pay off, I'm going to eliminate the 2 million. I'm going to withhold 5%, and I'm going to give that company 1.9 million. So basically I still owe them 100 and I still owe them 150. So I owe them 250,000, which on a $5 million project is 250,000. So that makes sense. So I've withheld 5% of the contract, waiting to make sure that everything is okay. Upon final inspection, the city incurred 75,000 of additional costs for interior rework. This rework was done by our employees of the city's general fund, and then the remaining retained percent was paid to the contractor. So it looks like we're not going to give them of the 250,000. I'm not going to give it all to them because I had to do a bunch of rework myself. And so this is part of the contract. It basically states that I'm allowed to do that if it's not at my specifications. So what we're going to do is we are going to eliminate the contract payable retained percentage. We're going to pay 75,000 of our own money, and then we're going to pay, and this is going to look weird, but that's how I did it. So we eliminate the contracts payable retained percentage because I'm giving them everything I'm going to give them. I'm going to give them 175, but then I also have to pay the 75 cash of my own to do the repairs. So the government-wide level, all we really know is that we spent 250. So we don't really care if it was to ourselves for things of our own nature to be able to finish the project, or if we gave it to the actual construction company. All right, so now the project is complete. And so now what we have to do is we have to close out the project. So we need to be done with the project. So there are some things that we have to do. We have to close all the temporary accounts. So let's go all the way back to the beginning. And what I'm going to do is I've got a blank sheet of paper here. It's just a blank sheet of paper next to my computer. And I could do T accounts for everything, but I'm not going to, because at this point, I just kind of need to know like what happened. This is an asset account due from federal government. So I'm just going to write due from federal government. And it was 100,000. Now I know I actually received that. And so remember, that's an asset. I have a revenue of 100,000. So I'm just making a note of that. I'm only going to look at the capital projects fund. At the government-wide level, I'm going to hold off because I don't need to do closing entries for that. So I'm only going to be looking at the capital projects fund right now. And so then here I received some cash. So I just wrote the word cash. And so you guys can't really see, but I'm just like making a note of it. And so I just wrote the word cash, and I received 50,000. And then I have an interloan payable current. Now I remember paying that off, so I'm just going to ignore it, right? Because I know that I paid that off. So I'm paying attention. Interloan payable current. Then here I have an encumbrance and a reserve. I know I reversed all of those. I reversed here. Okay, now I have an expenditure. I have an expenditure of 48. I do need to know that. And I just spent 48. So on cash, I'm going to do minus 48. Okay. Now on cash, I'm going to increase it by 3,050,000. And I have an OFS proceeds, which is 5 million. I have a due to debt service fund of 50,000. So again, I'm just like writing down like everything I have because I need to be able to close stuff. All right, so now I'm going to, in cash, receive 100,000 and get rid of due from federal government. So I'm just going to cross it out. So I had due from federal government, but now I just crossed it out because I know I've eliminated that account. And then this is me paying back that interfund loan payable. So in cash, I'm going to minus 50,000. I'm only looking for capital projects, funds, transactions. This is the encumbrance. I know I'm going to reverse it out. I have construction expenditures of 3 million. And then I know all my contracts payables are going to reverse out too. So I'm positive they're all going to reverse out. So you can draw T accounts for all of them, and that's fine. So I know all the contracts payables and all the retained percentages close out. So I'm going to reduce cash by 2,850,000. I'm going to do another construction expenditure for 2 million. The contract payable reverses out. I spent 1.9, so minus 1.9 million in cash. Contracts payable reverses out. Oh, that's the government-wide level. And then now I'm going to eliminate the contract payable retained percentage, and I'm going to spend 250,000. So I've listed basically everything I've had here. And what I need to do is I need to go to each of the accounts. And so right now in total, I have a revenue of account of 100,000 and I have an OFS bond proceeds of 5 million. So just noting what I have, I'm going to go ahead and just kind of make a note here. I have a revenue of 100,000. I have an OFS for 5 million. Okay. I have expenditure of 48,000. I also have a construction expenditure of 5 million. Okay. And so what I need to do is I need to basically get rid of all of those things. So this is getting rid of my temporary accounts. And so I also have a cash account and I also have a due to debt service fund. And so I've got to get rid of all of those eventually too, because I haven't given that money to the debt service fund yet. So looking at everything here, I need to, this is a closing entry. I'm going to get rid of my revenues. Okay. And so I have a revenues of 100,000 and I have an OFS bond proceeds of 5 million. And I have the expenditure of 48 and the construction expenditures of 5 million. So I'll probably just put all of them together. So one of the things I would do is I'd go back up to the 48. Where is that 48? That 48 here, I'm just going to add the word construction in front of it, just so that it's not a separate account. So I have a construction expenditure of 48, and then I have another construction expenditure of 3 million, and then I have another construction expenditure of 2 million. So I have a total of 5,048,000. So what I've got is I've got an extra 52,000, and I'm going to close that to fund balance. Okay. So at the government-wide level, when you close everything else, you'll close stuff, and we won't learn about that for a while. So we're not going to do the closing entry for the government-wide level, but our building is complete now. And so we do need to go ahead and eliminate construction WIP and create building. So what we need to do here is we need to, oh, I didn't mean to show you. So, well, that's good because it wasn't right anyway. So we need to eliminate construction WIP. And we need to create a building account. So what I need to do is I need to go back and find all the construction WIP accounts at the government-wide level. So I have construction WIP of here, 48. And then looking forward, I have another 3 million. And then looking forward, I have another 2 million. So I spent 5,048,000 on building the building. Okay, so that's at the government-wide level to eliminate construction WIP. But what we need to do now is we need to figure out what all we've got left. So looking at all of the accounts, I need to look through and see what balances are left here. And so we would have to go all the way back to the beginning of the project. And so our project, this project began on page, a really long time ago. Okay. So all the way back on page 5. So looking at accounts, I closed my revenues, so that's gone. Due from federal government got gone too. Got gone. It's not proper language, but as far as cash goes, I'm going to go ahead and color each of the caches so that we can come through and make sure we've got them all right. So we have cash. I know the interfund loan payable got paid. We have encumbrances of reserves. Those got reversed, reserve and encumbrances. Construction expenditures got closed, but I've got cash of 48. I've got cash of 5.5. Now I actually wrote it on my sheet, so I kind of know what I have for cash because on my sheet that I wrote on, like normally in class, I could just show them that I wrote on a sheet of paper, but I just made a list and I'm like 50 minus 48 plus 3,050,050. And I just kind of went through. So that was 5,050,050. Okay. OFS bond proceeds got closed, but I still do have this account. So I'm actually going to make it a different color because I've never paid the people. Like I never transferred that money. I should have transferred that money by now. I don't know why I didn't, but just keep an eye on that. And then here I've got more cash coming in. This due from federal government. I did pay them back. So, this is me paying them back. So due from federal government was up here as a debit, and now I'm paying them back. Okay, so interfund loan payable, I paid that back, but I do have this cash of 50 as a credit. Going back to the capital projects fund, this encumbrance got reversed here, and I already closed the expenditures and all the contracts payable got paid. So what we have is we have a reserve, we have a fund balance account, a temporary account that got closed. We have an expenditure that got closed. We have a liability account, liability asset. I do need to keep track of that asset. I'm trying to keep track of what I've got for cash. Reversal, expenditure got closed. We paid our contract payable. We paid our contract payable. Cash, keeping track of that. And then we paid our contract payable retained percentage, and I paid some cash. And then this was me closing my revenues, my OFS, and my construction expenditures. So right now I do have a fund balance of 52. So I'm going to keep track of that with an even different color. So I think those are all the accounts that I have left. So I actually have cash. And I also have due to debt service fund. But I actually have a third one because I do have a balance right now in fund balance. So due to debt service fund right now is sitting there at 50,000 and fund balance is sitting there at 52,000, I think. So the orange one, fund balance is 52, and purple, I see, I guess it was green, due to debt service fund of 50. And then I need to go through and find my cash. Go all the way back to the beginning, start at the beginning. All right, I've got 50,000. And then I paid 48. And then I brought in 5,050,050. And then I brought in 100. And then I paid 50. And then I paid 2,850,000. And then I paid 1.9 million. And then I paid 75, and I paid 175, and I'm left with 102. So cash has a balance of 102. So this is a debit. Okay, due to debt service fund is a credit, and fund balance right now is also a credit. And really what I have to do is I just have to basically give this leftover money. I'm going to give it all probably to the debt service fund. And so it would have said as the capital project was created, but if we finance this project with bonds and the debt service fund is going to go ahead and take care of the bond, then they're going to get the money to be used to repay the bond holders as we start repaying them principal and interest. So for the capital projects fund, though, what needs to happen is we need to go ahead and eliminate the, eliminate the balance in cash to give it up. And so we're going to go ahead and debit due to debt service fund. So let me go ahead and delete what's there. Your book does it a little bit different than I would do it, but I don't know how I want to show you guys. Because really what's going to happen is we're going to go ahead and get rid of like due to debt service fund. I'm going to do it the way that makes sense. So I think that's probably the easiest way to do it because we have 50,000 in there. We also need to eliminate the fund balance. But what the book tells you to do with this, and so we all acknowledge that all the money, the whole 102 needs to be given up, right? And so So to me, it makes sense to just debit fund balance for 52. Like that's what makes sense to me. But what they do is they do an OFU, interfund transfer out, so that they can transfer the 52,000. And so the debt service fund then would have an OFS. So the debt service fund would get an OFS, interfund transfer in. So let's do it that way. And then we need to close the OFU. Because that is a an operating account, like OFU is like expenditures, and we would debit fund balance by 52, which would then eliminate the balance of fund balance. So this is the proper clean way to do it, so we can keep track of OFUs and OFSs. So due to debt service fund, eliminated, cash, eliminated. And then we put this in to immediately take it out. So the OFU wipes out, and then the fund balance of a credit is debited for 52. So it's also eliminated. So that closes everything. The debt service fund then would receive the 102. So we would acknowledge that they would be receiving the 102,000 because that's where all the money goes. So they would receive cash of 102, and they were expecting 50. They were expecting that premium on that $5 million bond. So they had due from Capital Projects Fund. So they were waiting on the 50,000, and then they also got another 52. And they would call that OFS. Interfund transfer in. So here we have an interfund transfer out, because we're getting it out of the Capital Projects Fund and moving it into the debt service fund. So anytime you have a due to, you'll also have a due from, and anytime you have an OFU, you'll also have an OFS. So, all right, so that is basically it. And so, so that's it for our chapter 5 notes. And so what you guys will do is you're going to go on and do the chapter 5 homework. And so if I pull up that chapter 5 homework student, a lot of stuff going on. I think it should go pretty well this time. You're going to do the multiple choice, and then you're going to do 2 problems. And so those 2 problems, one of them is another journal entry one. When you do the T accounts, the balances will come in automatically for you, along with the checking of the debit and credit. But the nice part is that the balance sheet will also happen automatically. So I have this connected to the T account page A7. So it's connecting to that number. And so once you get the stuff posted, the balances will compute automatically and your balance sheet should equal. I forgot to tell you the number it'll equal that though, but I will go back and find that and make a note of it. And then you'll also do an income statement. And so, and then you're going to go ahead and do problem 510, which is another one of the capital projects funds with T accounts that the balances will compute automatically with a balance sheet that will equal. So I'll go back in and give you check figures on both balance sheets. So you have that. And so I think it'll go pretty well. I'm hopeful. I'm kind of excited. I love your homework. I think it's so much fun. I don't know, because I'm a nerd. So, all right. I hope you guys are doing well. Have a great week 4. Thank you.